Thank you for joining us for what I anticipate will be a fast-paced, highly informative webinar. I'm Dan Winters, Senior Director at GRESB. We're based in Amsterdam. I'm located in Washington, D.C. Started in 2009 by a group of leading institutional investors, GRESB serves as the North Star for the global real estate industry, driving progress on the business issues of our time. In 2018, GRESB launched the Resilience Module to further the industry's ability to understand, measure, and manage investment risks in a changing climate. The standalone module was retired in 2021. Resilience principles are now infused into the main GRESB real estate assessment. Last year, GRESB members submitted over 2,000 portfolios covering 170,000 buildings located in 70 countries. Portfolio and asset resilience is firmly embedded in the industry's lexicon. 2024 marks GRESB's 15th anniversary. 15 straight years of benchmark growth. Progress is at hand. A few housekeeping items as we settle in today. First, the recording will be available following the program. You'll receive that via email. Second, we're seeking a robust Q&A. Please put your questions in the chat. You can see that down in the lower right-hand corner in the icon. Looks like the chat icon. Post your questions there for any and all of us. The GRESB team will be keeping an eye on these questions throughout. We're aiming for 45 minutes, but like a good EU football match, I expect extra time. We have an excellent audience today, multiple hundreds of professionals from the real estate industry and infrastructure private equity firms, numerous REITs, several rating agencies, a wide range of ESG professional services firms, and our industry association partners from around the world. For the audience that's assembled today, 3 takeaways in advance. 1, weather-driven climate damages are real and they're increasing. Sophisticated GRESB member firms are taking serious steps with their portfolios. Insurance companies are retreating. Premiums are doubling. Deductibles are doubled. Coverage is halved. Financial exposure is acutely felt by all. Third, risk management is at the core of all successful investment management programs. Existing portfolio analysis, new acquisitions, we're going to dig into both of those issues. We have an exceptional lineup today, all long-standing GRESB members and partners with very valuable perspectives to offer. So let's start off our intros with Brad Doxer from Green Generation, longtime expert using sustainability-oriented ideas to drive superior investment returns. Brad, welcome. Tell us a little bit about your firm. Kick us off.
Dan, thanks very much. So I'll just start by giving a little bit of background and context. So I'm the co-founder and CEO of Green Generation, or GreenGen, which is a global sustainability firm operating in Asia, India, Europe, and North America. I'm also a global governing trustee of ULI, as well as a board member of the ULI Randall Lewis Center for Sustainability. And I think that's important because some of the things we'll talk about relate to research that ULI is doing to bring the various stakeholders together around this issue. GreenGen was founded in 2011 and today is one of the leading global sustainability firms. We're helping investors, about 70%, public sector about 30%, transition to a low carbon world where they can drive both a financial outcome but also drive a climate outcome at the same time. And much of the work that we do is changing the conversation from how much something will cost to how much value does it actually create. Our team is about 2/3 engineers, so we're very quantitative, we're very science oriented, and we're focused on all 4 levers of helping to move toward a net zero world, which includes energy efficiency, on-site renewables, off-site renewables, and offsets. It's interesting because as we think about physical climate risk, this is an issue that's increasing, and it's not just limited to the United States, where we think about places like Florida or Texas or flooding across the eastern seaboard. It includes the Mississippi River. Iowa is among the most flood-prone states in the entire country. Europe, where you've had both excessive flooding in Germany in the rivers, but you've also had excessive drought, where actually the barges are not able to actually move forward and transport people and goods. India, where you've got excessive heat. Just this month, Delhi has been, I think, above 104 degrees for more than a month. in terms of high temperatures, making it inhospitable for nearly everyone there. And of course, Asia, where the greater basin, the Chinese basin that includes Hong Kong, Guangzhou, and Shenzhen, puts more than 70 million people at risk for flooding on a regular basis. So this is not an issue that's limited to one area, but in fact, this is an issue that really impacts everybody. And I would say that the people who are doing the best job are thinking about this are not just thinking about the risk that physical climate presents, but they're thinking about it in terms of how do they create a competitive advantage. We are today in a world of stakeholders. The traditional view would have been, I own a building, Dan, I sign a lease with you, there are two stakeholders. Today, it's the person signing the lease, it's their employees, it's their customers, it's their supply chain, their investors, equity and debt, public officials, and all of them are impacted by physical climate risk. When you invest in resiliency, when you invest in hardening your asset, you give yourself a competitive advantage against your peer group. And in a world that is shifting from strategy, I know what to do, to action, I'm actually doing it. This is in fact a really critical thing. And so I think the final point is that, as we're thinking about insurance, we used to often talk about the cost of insurance. And increasingly, we really need to be talking about the availability of insurance at all. As insurers are leaving markets, as we're finding it's more and more difficult to even place insurance at all. And when you can't place insurance, if you're debt financed, all of a sudden now you can't get debt. And so this has very significant implications. And I look forward to the rest of the conversation.
Excellent framing, Brad. Thank you. So glad to have you. You always bring your A game. Love it. Next up, Raghavir Vinukolu from Munich Re, foremost expert in applying Munich Re's location risk intelligence platform, which is used by many in the institutional real estate industry to drive forward projections and business decisions through the lens of climate resilience. So I just want to start first with some Munich Re stats. 143 years of risk expertise. It's the #1 global reinsurance firm, 67 billion euros last year in global premiums underwritten. In 1973, 50 years ago, Munich Re issued its first global warming alert. In 2020, they launched the climate risk analysis tool to help institutional investors uncover their climate risks. Raghavir, welcome. Tell us a little bit more about the recent advances in the Munich Re climate risk tool.
Thank you, Dan. Hopefully you can hear me okay.
Gotcha. Go ahead.
Good. Great. Well, good afternoon, everyone. So my name is Raghavir, and I am a part of the business unit of the reinsurance division of Munich Re US, which is part of the Munich Re Group. I primarily focus on the title being the Climate Insights and Advisory. That's really my role. And well, Dan, thanks a lot for that introduction. I always say that Munich Re it's a small reinsurance company, but I guess you revealed that secret. So why is it important for us? As you mentioned it, Dan, that this is something core and center in terms of understanding the risk. And so we started looking at this, the word climate risk and collecting data all the way from 1970s, right? And that was actually the German floods. So I really like some of the points that you made, Brad, in terms of not just thinking about risk, but the competitive advantage that clients are looking for. And so from that perspective, what we think about resiliency is more of two words, which is fall forward and not fall back, right? And I think that is the competitive advantage that we look into. And my role is really to work with clients, and the clients for me define as everyone whether it's a property owner, a real estate asset owner, or even a public sector, or even our own insurance clients as the cedent companies. And what we are really talking about is constantly thinking about what we call it as the risk transfer continuum, right? And the risk transfer continuum says that we start with proper risk assessment, If we do not assess the risk properly or communicate the risk properly, then we haven't started the real discussion yet. So identifying the issue and addressing the real problem by asking what is the problem, right? And then when it comes to the risk mitigation or the risk management part, so that is really the second step in terms of, and that's when comes the risk transfer. So we cannot address the risk transfer or the insurance equation or the financial resiliency of anything without addressing the risk assessment and the risk management or the mitigation aspect of it. And climate risk particularly plays like a very interesting role because it's unlike any other risk because it's constantly increasing, and some of the numbers that you mentioned, both Brad and Dan, how things have been impacting the world. But let's just take something as of yesterday evening, the dam failure in Minnesota, right? And that has. And what has caused that 18 inches or more of rainfall over the last few weeks? Is this a new story? Is it? I mean, it's really a very unlikely outcome and not a good outcome for the local communities. But can we see the correlation? The Michigan dams that failed in 2020 was the same reason, right? Extreme rainfall. So extreme rainfall is going to become an issue. So with climate risk, this risk is going to keep increasing gradually. So the next 20 to 25 years that we know we are going to see a lot more extremes. So the question for us will be, how do we manage the risk? And only when we manage the risk can we actually have a sustainable insurance solution. So I'll stop there, but I'm looking forward to the discussion.
I like your framing. No, I love your framing. The two steps, which is understand the risk and then really dive into the asset and figure out what to do about it. So that's going to drive our conversation today for sure. Okay, we've got one square to go. An exceptional webinar needs a ringer, someone in the middle of a fray who's driving change and leading the way. It's my pleasure to bring Nicole Wilson from KKR into today's program. She is an ESG's expert, professional experience as both an LP institutional investor and now as a GP fund manager. Welcome, Nicole. Give the audience some perspective on KKR and the real estate unit's climate resilience efforts.
Perfect. Well, thank you so much, Dan, and nice to see you, Brad and Raghuveer. Really excited for the conversation today. Maybe I'll just start by providing a little bit of background about who KKR is and our real estate business, just to provide some context and my role. So before I had a bit about me, more about the firm. So KKR was founded 48 years ago and is a global investment firm investing across private asset classes. And our real estate business was founded in 2011. So right next to you, Brad, as you stood up GreenGen, and a few years after GRESB was founded. KKR as a firm has over $570 billion of assets under management, and our real estate business has over $70 billion of assets under management, both in equity and in credit. So we either own or lend on around $250 billion of real estate, and that's global. It's a diversified portfolio of over 2,500 assets, not including our single family residential portfolio, and over 190 million square feet. So we have a lot of buildings, we have a lot of real estate, and so that's why it's important to understand material sustainability issues that can impact them, but from a risk perspective, but that can also allow us to create value through sustainability initiatives. In my role, I am a director within our sustainability team, and I lead our global real estate efforts, working in close collaboration with our real estate investment teams to identify risks at acquisition, and then I think actually more importantly, creating value through sustainability measures post-investment. We recently onboarded the Munich Re tool into the sort of KKR family of sustainability resources, in addition to the GreenGen team, to help us identify those risks at acquisition. And now we're thinking through working with experts like Brad and his team. How do we think about asset level resiliency measures? How do we think about prioritization? What's the cost of inaction versus the cost of action? How do we think about insurance premiums? All of these great things that I know that we're going to dive into today. So before I take any more time, let's dig into it.
So many things to unpack here, right? And climate resilience is such a timely topic, and I think Raghavir really hit it on the head. So we've got heat domes represented by Brad and I in Washington D.C. We've got torrential downpours that happen in Miami, F4 tornadoes that hit Iowa, floods in Minnesota that have led to dam breaks. We've got forest fires, and that was just last weekend in the United States, affecting over 200 million people. Weather's increasingly extreme, and this is globally. Mother Nature's agitated, real estate is exposed. Right, I've got a lot of stats here in the last 3 years, 66 weather events in the US, greater than $1 billion in physical damage in each one of those events. Buildings, vehicles, roads, bridges. Some events are bigger than others. The total economic loss estimates from 2021 to 2023, $440 billion. So the best minds in the real estate investment business, sober, pragmatic business people, maintain the mantra: be aware, be prepared. 2 parts to the conversation: portfolio resilience assessment, objective, what are the tools available, things like Munich Re, what happens next, and then dive down to the asset. So Brad, let's kick off. Let's start with you. And let's talk, portfolio is kind of where you start, and then dive into the asset. How do you help your clients move forward here?
Well, I think one of the key issues is to sort of think about what you want your portfolio to look like and which markets represent risks that you're willing to tolerate and which perhaps that you're not. It's ironic that probably the greatest macro story in the United States is South Florida.
Yeah.
And yet at the same time, the greatest climate risk MSA region is South Florida. And different investors have reached different conclusions as to whether or not they're prepared to tolerate that risk to get the outsized returns they expect to get in that market. Others have said that market represents a physical climate risk that we're not prepared to take. I think the other thing that we find very interesting is that there's a difference between your existing portfolio, assets that you already own, and assets or markets that you're going to look at. If you ask an IC, if you ask the senior leadership at a lot of funds, their favorite assets, they'll tell you, we have this great building in New York, we have this great building in Boston, and, but then they say, but we want to focus on markets that perhaps have a little less climate risk. Not recognizing that in many cases, they're already exposed to significant climate risk. And I think this is a bit of a blind spot. And the Munich Re tool has the ability to sort of look at MSAs, look at assets, and help you think about, hey, if we're thinking Tampa has less risk or Columbus, Ohio has less risk, in fact, empirically, that risk might be identical to Lower Manhattan, or Midtown Manhattan. And I think it's really important to sort of level set as you start to think about portfolio.
Great. Let's shift it. Oh, no, go ahead. More? Let's shift to Nicole. So Nicole, talk a little bit about what your thinking is as you moved with Munich Re to adopt this platform for now, and from the portfolio to then get us down to the asset. How's it working for you guys?
Yeah, so I think Munich Re is the starting point for a broader expedition as it relates to understanding sort of asset level resiliency, asset level exposure. And I think for us, it's an incredible tool that is a great proxy for understanding physical climate risk, both acute and chronic risks. And so when we onboarded the tool a few years ago, we started with doing a portfolio level assessment, both of our equity and credit investments. And then from there have been able to sort of scope out which assets are at heightened risk. So those assets at exposure to higher extreme acute risks. So then we can prioritize the asset level engagement that needs to happen in order to harden those assets, and to understand in a little bit more detail, working with technical experts who will go on site to say, what is the cost of action? What is the cost of putting in a flood wall versus what is the cost of inaction? And how is this going to interplay with insurance costs as well? So that information and understanding your existing portfolio's exposure to physical climate risk, and then the resiliency measures that may be on place already in your existing assets, helps to then inform your understanding on a go-forward basis, to Brad's point around making new investments in markets that may have similar types of exposure from an acute or chronic hazard perspective. But I just wanted to pick up on one of the points that Brad made, because I do think that it's an important one. Oftentimes we get asked the question, and having sat in both the seat of an LP and now a GP, you get asked the question, why are you investing in these markets that have, heightened or extreme climate risks, acute hazards? And so after we did sort of a portfolio level assessment of our real estate portfolio, the second step was to dig into understanding the interplay of these risks with broader macroeconomic trends. So understanding demographic growth and understanding GDP growth in cities. So what we did is we took a look at the quote unquote climate haven cities, although I think those are becoming fewer and fewer as we recognize no city is immune from climate risks. And we looked at a combination of their GDP growth and their demographic growth, and they paled in comparison to the cities and the markets that we regularly want to invest in, viewing the heightened growth trends that exist there, but that may have exposure to acute risks. And so I think it's really important to understand that while physical climate risk is part of the puzzle, it's not the whole puzzle that we need to consider when we're investing. And so that's why it's really important to focus on investing in high quality assets and hardening those assets that may be exposed to some of those acute risks.
Investing is an art, not science. I'm hearing complexity continue to show up. We're going to start to dig into that when we talk about the asset side. Raghavir, when you observe your clients, are they using the tool as designed? Is it providing the kind of discussion driver and business value that you envisioned when your firm set about to build this tool?
Absolutely, Dan. I think. So I would like to start with, first of all, I really like what you said, be aware, be prepared. That's really so important. And I also want to address your earlier points about how insurance companies are kind of revisiting, right, certain areas. Is the risk is going way too high? Is it being able to something that they can monitor and manage, right? And just as an insurer, reinsurer, how we think about this risk equation is just a mention of the three functions, three parameters that we look at. This is implicitly or explicitly that we think about every single day, which is risk as a function of hazard, vulnerability, and exposure. Right, and so we're going to talk a lot more about exposure in this particular audience for this particular audience. But let me just touch a little bit on the hazard part. The hazard, as I mentioned earlier, is nothing we can do over the next 20-25 years. The emissions can all go to zero today, but still the climate of the future is something that is going to be uncertain and more extreme, right? And so it's not really in our control. The vulnerability is definitely something, again, at an asset level, as Nicole and Brad have mentioned about, right? These are things that we can manage based on what we know about tomorrow. So the past is not a representation of the future. So what the tool, the location risk intelligence tool, gives is that information about those acute and chronic risks that Nicole was mentioning about, and saying, okay, what is it with a time frame of 2030 or 2050, with a certain scenario of how the projections are looking like? What is the risk? And so that hazard information is valuable to take those decisions and convert those into actions on what kind of vulnerability assessments, what kind of vulnerability adjustments that we will have to do at an asset level. It's really important that we manage, again, a portfolio. I think we were having this discussion earlier where I think Brad was mentioning about a portfolio can be resilient, but I think where the decision making starts is at the asset level. So this information we thought was going to be very useful, and that's how it has turned out. And so coming to the exposure part, right, and this is how the insurance companies are constantly evaluating. Is the risk going up, and how is my aggregation looking like in different regions? And the regions does not mean only political boundaries. It can be a watershed where I'm a hydrologist, so I can always think about flood first. I think that the watershed boundaries are what the floods will follow, so that those are ways to aggregate and understand the risk. That's what, and so the companies, the insurance companies, are going to manage their exposure based on the information from this hazard and vulnerability. So bringing it back to a real estate like developer and so on and clients, the vulnerability can be addressed by mitigating the risk. And this is where I will also introduce another concept called the feedback loop, right? If the risk is increasing, then we are going to assume that the premiums are going to increase. In general, the industry and in the past, the way things have been addressed is by managing those limits and the deductibles and so on. But that is if there is like a stepwise increase or a moderate increase. But if we are seeing extremes like Hurricane Harvey and Superstorm Sandy and there are Hurricane Ida and these dam scenarios and the wildfires in 2017, 18, and the list goes on, then the question always arises, is there any other way to address this feedback loop? Because otherwise the risk is growing, and so we are increasing the premiums, and then it becomes a question about two aspects, affordability and availability, right, of insurance. So that is the constant thought process that we have while developing these insurance solutions and addressing our portfolios. So the other way to manage that is coming back to, again, the point of risk mitigation. So to address that feedback loop and manage it, we can address risk mitigation, which is the only way to manage, I think, the long-term affordability and then also the sustainability. So this is exactly the thought process that went into when we developed this LRI. We're taking the risk ultimately. We are a reinsurer. We take the risk. So we want to understand our own view of risk, but at the same time communicate that to our clients. And that is what the whole purpose and the journey of location risk intelligence has been.
Excellent. So we're seeing some questions come in. Don't forget the lower right-hand corner. Questions on gross asset value at risk. But typically, once you run a portfolio through the Munich Re, you're now looking at which ones are most exposed, and is that asset worth a lot or a little, and what does it take to bring it up to some resilient standard that meets investment criteria. So let's go back to Brad. Brad, can you talk a little bit now that you've got some awareness, right? The be aware part. Now let's talk about asset specific, be prepared. What kind of strategies go into place when you get in there and you look at a very specific asset on a piece of dirt?
Dan, our view is that everything about insurance comes down to two things. It comes down to the probability of the event happening and the cost of the event should it happen. And physical climate risk actually impacts both. You can put up, barriers to prevent flooding. That is something that basically will keep the event from happening. At the same time, you can put window film on, say you're building in South Florida. So it doesn't stop excessive wind, but it reduces the cost of the event should it happen. If excessive wind comes, your asset is less likely to incur the cost. Now, when you start to do those two things, you also start to have, insurance as a lever of creating value. You can basically you can think about how your deductible works, which will impact the cost of it. You can think about, if you take measures, you can inform your insurance company on the primary side so they know what you've done. And again, you may see reductions in the premiums. And that starts to where you have ROI, because most of this conversation is always about the cost of resilience, the cost of making the investments to harden assets. We don't think about the return. The other part of it is in a world of what I'll gently call lower demand for real estate. Office is much more significant than other places. You're going to see assets that are perceived as better. They're going to have higher occupancy, better rents. They're going to be more attractive to tenants. Going to be more attractive to their customers. And so your assets also see a return on the income side. And I think it's really important to sort of change the conversation just from the risk itself to how does the risk actually impact the value of assets? Because Nicole is right. I mean, Nicole made the great point that, yes, we need to look at physical climate risk, but it doesn't mean that a market is redline. It doesn't mean automatically that we will not invest in South Florida. We have to incorporate it as part of the investment decision, and we have to weigh the increased risks, the VAR for a building in South Florida versus somewhere else, relative to the GDP growth, the employment growth, and the overall return of the asset. And I'll close, or at least this moment, when we're doing acquisition due diligence for our clients, including for Nicole, we are absolutely thinking about physical climate risk. It is a fundamental part of what we're doing. Even if an IC is not focused on it, it's important to start to level set and to start getting people to think about how one asset vis-a-vis another sits relative to climate risk.
Raghavir,
I know that you've got some reactions to this. Go ahead.
Yeah, so I just want to add on to Brad's comments about the insurance aspect here. I mean, I like to think of insurance as a financial resiliency tool that is available for an unforeseen event, right? And it's not, and so with that, what climate risk is changing is the frequency and the severity. But more importantly is the frequency, how frequent these events are happening. And if these frequent events, especially the smaller events, can be managed with risk mitigation, that is when we can start thinking about the best value for insurance. So again, just wanted to highlight that frequency versus severity. We need to be very careful, because that the insurance should be not trading dollars. It should be a financial resiliency tool for an unforeseen event.
And if we may jump in here, I think talking about insurance and insurance premiums is sort of a good segue to say that, at least from our perspective, it's still very early days in terms of the insurance market being able to reflect asset level resiliency measures that have been put or been sort of implemented on site. And so I know that there's a lot of focus on this in the insurance industry as a whole, but it's still quite early. And then if you think about it as well from the perspective of, a large investor that looks at insurance, and you need to understand sort of the portfolio, because you're looking at portfolio level insurance as well. And so understanding how you can communicate to your insurance providers about your process helps them understand that you are mitigating risks, or at least are aware of the risks that may exist. And then perhaps just to jump back to a question that came in through the chat, which I think Brad touched on briefly, which was when we look at certain markets that have certain exposure to physical climate risks, are we looking at incorporating the impacts of elevated risk profiles on the growth prospects for these markets? I think yes, and is the answer to that, in that we do look at this from a sort of a macroeconomic perspective of understanding physical climate risk impacts. But really, what's important to us is being quite religious about integrating and underwriting some of the costs that are associated with this. So it's about understanding the insurance costs in some markets versus others, which are increasingly baking in, the effects of physical climate change. It's understanding whether or not you need to put in a $2 million flood wall for an asset that is exposed to flooding, and not realizing, during your hold period, oh, wow, I didn't underwrite this. And so now the return for this investment looks very different than what I thought it may look. So it's really about thinking about it from that perspective as well, in terms of being quite systematic of underwriting that. And so we've worked with the GreenGen team to develop what we would call as a bit of a cheat sheet for our investment teams, in that, yes, assets are systematically run through the Munich Re tool at DD. When an asset is flagged as being exposed to higher extreme acute risk, we have sort of a bit of a cheat sheet that says, this acute risk, these are the top 5 mitigation measures that you should consider, and here are the costs that you need to think about including in your underwrite. We need to likely get a technical advisor on site during technical DD, to understand this in a little bit more of a fulsome manner.
You're taking the questions right away from me. So a couple acronyms have worked their way in. Brad brought up IC, that's investment committee, and that also brings up due diligence, and that's what Nicole has been talking about, DD and due diligence. So we I've been sitting here on the edge of my seat saying, well, what happens next after the investment committee and the memo and whatnot? Brad, when that, so an acquisition moves forward, right? What does happen next? Is there a team that goes in, especially when there's some heightened risks that are identified?
But I think Nicole made the right point. You're doing acquisition due diligence to identify, key risks. But as part of that, you're also thinking about the mitigants to those risks. You're incorporating costs, and you're making sure that, the larger risks are part of the CapEx budget, that they're included, that the cost is included and, built up and reserved at closing, that the benefits are there. I think there's a difference, as you look at markets, there'll be a difference in an asset that's long-term leased versus one that has a lot of rollover or vacancy, because you need to appeal to people to get them into a market. What we haven't also touched on is sort of transitional risk, sort of what's going on in markets. Some markets, some cities are really proactive in terms of code, not just in terms of new construction, but also in terms of renovation. Others less so. And I think it's important to understand, what is a city going to require of you versus what are you doing voluntarily to meet the market and to create value. And I think everyone we work with, considers themselves to be good value-add investors. The reality, some are better at it than others. And one thing we haven't touched on, and be curious to sort of get Nicole's thoughts, is thinking about sort of life cycle versus first cost. This comes up all the time. Resiliency is one of those things that creates value, but it doesn't always create value in the same way increasing your rent by 5% does, or leasing another space. It doesn't automatically appear in the income statement, but it does reduce the volatility of the income. It will impact the cap rate. It may impact what your debt looks like, either in terms of the cost of capital or the proceeds. It comes up and creates value in a lot of different ways, but I think it's a next tier, if you will, of sort of thinking about it, because it's not as obvious as some of the things that we're used to seeing.
Let's unpack it, Nicole. What do you think?
I wish I had all the answers. I mean, I think it's a really interesting question, and one that we at KKR still, I would say, more in the early days of thinking through what does this mean in terms of sort of asset level implementation. We've been quite lucky. We work with a lot of great operating partners throughout the world. And as a second part of our portfolio analysis, we went out to them and said, hey, we've gotten these results in, looks like there's some exposure to risk here. Here are the mitigation measures that we think are most important for us to be considering. Can you tell us if you have these currently on site? Let's do a little bit of unpacking here. We were pleasantly surprised in that, of the assets that are exposed to heightened risk, many of them have at least one physical mitigation measure in place, of course, beyond insurance. And so at least we're starting from a point of not starting from scratch in most instances in terms of understanding what needs to be done. But I apologize, Brad, in that I can't dig into that too much further, because I still feel we're in the early days where it's, understanding the assets that are at our heightened risk, and now we're moving into the phase of let's roll up our sleeves and think about what additional mitigation measures we need to put in place, and then we can think about are we using replacement cost or the absolute value of the asset to be thinking about those types of issues.
Nicole, don't sell yourself short. The first thing is knowing who to call, right? And that's understanding which assets are most at risk. And then the next thing is what to talk about when you have that engagement with your local operating partner. So sounds like you're doing great for sure. Raghavir, what I think the big theme that's coming here is resilience issues are complex. Professionals seek solutions, and what they're looking for is complexity made easy. And so a loaded question, but is this possible? And just kind of what's your reaction to that? Because $67 billion of underwriting requires a whole bunch of decisions and leaps of faith.
Yeah, I don't know if there is a simple answer to that, right? But at the same time, it's definitely not rocket science as well, I would say, right? And so I think some of the things that we have all collectively said as a panel, I think it's bears repeating, right? And the aspect that one, how risk mitigation is important at the asset level, right? And what we have done so far has always been we have built only for the past climate, And that needs to be absolutely crystal clear in our mind, that thought process has to change. And some of the work that is happening, I think Brad touched on it a little bit, on how some cities are working towards it, some counties are working towards it. These resiliency planning efforts that are happening, especially in South Florida, right, and the Tri-County region and other regions as well. But I think it's really also important to have the discussions with these counties and regions as they are preparing these plans. Even Munich Re, we forced ourselves in a way onto the table to really say what are the infrastructure plans that will happen over time, and what kind of resiliency or financial resiliency measures they may need over time. But more importantly, the decisions that will be made in terms of either building a flood wall or a levee or something, what is that impact on the infrastructure, on the assets that are behind those, right? And are those benefit cost analysis happening? And that's also, so these are things we have gone beyond our traditional role of just being the risk taker. We're actually actively involved in these dialogues about how this will impact the broader community. I also want to touch base on the physical risk is absolutely important, but not only for that region, right? And it's really important to understand that, because this is also impacting the supply chain. There must be something, there may be some areas of the world, and we have seen events like the Thailand floods or the Japanese tsunami, where things have impacted the operations across the world, and there could be no better example than the pandemic as well, right? So but when we talk about physical climate risk, it's not just the impact on the asset itself, but also on the other operations. So the supply chain impact is also really important to think about. So I would say, again, it really comes back to, is this difficult? I mean, that we need active dialogue, and from a Munich Re perspective, we are open to have those conversations, and it all starts with communicating the risk, as I said. So I think the LRI tool is really the starting point, but we are up for more discussions.
Great. Interesting question just came in. And so let's move from the macro down to the real micro. Any vignettes about how tenants are reacting? So when they're looking at a building and they're considering A versus B versus C, the resilience measures matter to the tenant? Are they asking these questions? And if so, is there any ability to tag any rent amount or premium, if you will, to the investments that have been made in the asset? Let's start with Brad first. Brad, anything?
Well, yeah, I mean, this sort of goes to a much more macro question that we always get asked: brown discount versus green premium.
Yeah.
I can't tell you for sure that you're going to see basically, a rent premium for investing in resilience. But if you do it right, you'll get the tenant to sign the lease, and you'll get the occupancy higher. And if you don't do it, then you're going to see your occupancy drop. You're going to see your EBITDA drop. And so there's different ways to think about it. I also think, one can get their head around the idea of investing in resilience will stabilize the cap rate. It will reduce the volatility of the income stream. It means it's a more stable asset, and it's got more value there. Different ways to think about it. But what I do know is that there are more and more stakeholders, i.e., tenants, their employees, their customers, that are thinking a lot about this. Customers, in particular, are asking the question of the people that they work with and the space they're operating. Do you have backup? Are you in a resilient asset? What types of risks are you focused on? I think it is ironic that, a decade ago, a lot of the New York banks were doing backup locations and secondary locations in Baltimore and Tampa, both of which, Raghavir, you can back me up here, have a pretty significant physical climate risk, value at risk, and that's where they were going.
Yep.
That's not where they're going anymore. They're now going inland. They're going into Ohio and Indiana. They're looking at other types of locations, which again have risk, but they're different types of risks.
Nicole, any reactions to this?
Yeah,
Anything?
I love this question because I think it brings it back to something that is often easy to forget when you're focusing on discussing a building, sort of structural components, what a resiliency or mitigation measure looks like. But real estate ultimately is about people who live, work, play in buildings. And so when we think about different asset types, to Brad's point, I can't tell the audience whether or not people will pay a climate discount or climate premium based on resiliency measures. But what I'm certain of is that folks want to be able to live safely in the home that they choose to live in. And what I'm certain of is that businesses want to be able to continue to operate when, even when there are acute physical climate hazards that are occurring. And so I think it's, again, I mentioned it earlier, it's early days in having the evidence to prove out this thesis. But I think ultimately people want to live in homes and work in places that they believe are secure and that they believe that they're safe in. And so with that, one could sort of theorize that you will likely see some sort of price impact or impact on demand. But just sort of a final point on this, I think it's an important one to raise. We talked a lot about the first order impacts of physical climate change today, sort of the flood that impacts an asset, but we didn't talk about some of the second order impacts, which is how is physical climate change going to actually shift where people want to live, work, and play long term. And I think that these are things that folks like us sitting in this conversation need to be thinking about, because that is going to shift over time. People will not want to live in the hottest cities where there is no tree cover, etc.
Brilliant. And so we're into extra time, like a good soccer match. Thank you. And that's a great segue. My question, sort of a grab bag question to everybody, is what do we leave on the table with this conversation? We've talked about portfolio. We've talked about asset. We brought some, tenant safety issues in. Anything that we missed that it would be important to the audience? And then we're going to end with a strong closer. Raghavir, Brad, Nicole, themes that have been left out here?
I'm sure there have been, but I can't think of them at the moment. And we're always available if people want to reach out to us with any questions they may have.
Yeah, Dan, I'll make one point, which is the industry for a long time has asked its property managers, its engineers, to basically keep an asset running and don't spend any money. Don't come back, ask for money. And what we're sort of advocating here is that if in fact you invest $1 million in an asset, but at the end of the day, when you've made that investment, you can know with certainty that the asset is in fact worth $2 million more. The question you have to ask yourself is, did it cost you $1 million to do this, or did you actually get paid $1 million to do it? Because your net asset value has gone up by $1 million. And while it seems maybe obvious to us what the answer is, it is not obvious to a lot of people who've spent their entire careers being told, don't spend any money, just keep it running. The last thing you should be doing, because it's a career killer, is to ask for CapEx from the asset manager. Don't ask them for anything. Just keep it running. And the engineers, their job historically has been to keep tenants happy. They've not been focused on driving the EBITDA, or the value of the asset. They're largely measured by property managers by how many complaints they get. So the fewer complaints, the fewer work orders, the better they're doing, regardless of whether they're creating value or not.
Interesting point. Spot on. All right, let's close this out. Top tip for the audience. What, something that I started with some takeaways, 3 takeaways for the audience. Let's end it with one from each of you. Can I start with you, Nicole? Anything that you want to offer?
Sure. I say it a lot in the work that I do, because there's always an element of uncertainty. And I think people always want evidence and proof points, and they just really want the data in order to be able to move forward. But I would say don't let perfect be the enemy of progress, in particular on this topic. So, the first step is building your climate intelligence as an organization. From there, you can then prioritize where you want to focus your attention, and then from there you will get increased proof points. But I think it's keep moving forward and don't let perfection slow things down.
Beautiful. Brad?
try to avoid thinking about how much something is going to cost and think about how much value does it create. Everything costs something, but if it costs, 5 million, but it creates 10 million of value, that's probably a pretty good investment.
Wonderful. Raghavir.
So yeah, I would put it this way. I'd say when we talk about climate resilience, there's both the mitigation aspect and the adaptation aspect, and I don't want us to prioritize one versus the other. Both are important. But however, I want to say that adaptation is the need of the hour. It's absolutely critical. And having said that, I want to kind of double down on what Nicole said. Let perfection not be an enemy of the good, right? And what I mean by there is we need adaptation pathways. What information we know today, let's act based on that. Does not mean that that's a snapshot, that's a fixed aspect. We may know a little bit more information in 5 years from now, and let's act accordingly. So that adaptation pathway is critical. Small steps are more important when it comes to adaptation. But again, adaptation is the need of the hour.
Great. And for me, inertia is the foil of progress. Firms that are stuck on issues, they risk, competitive atrophy. I think that kind of sums up what everyone is saying here. So let's close. Thank you for attending today's webinar. A lot of excellent questions came in. Great conversation with the panelists. The recording will be coming your way shortly. October 1 marks the release of the 2024 GRESB results. Please be sure to watch our events page as GRESB recognizes 15 years of industry progress. Thanks for attending today. Thank you to the panelists.
Thank you.
Thanks, Dan.
Thank you.